Hi, my name is Jordan Wilson. Today we're going to start taking a look at a very important investing concept, diversification. We'll probably break this down into two parts, and we're going to look at how asset correlations relate to diversification of a portfolio. Our overall objectives will be to take a look at what is diversification? How does that differ from asset correlations? Then we'll look at a few examples to sort of bring how asset correlation and diversification come through in the real world, both from a common sense perspective and from an actual investing, building a portfolio side of it as well. If I look at our good friends at Investopedia, and Investopedia does a good job, lots of very good information on there. Their definition of diversification is that it's a risk management strategy that mixes a wide variety of investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to any single asset or risk. The rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower the risk of any individual holding or security. So that's a quote from Investopedia. I definitely understand what they're saying. I have a few disagreements with what they say, but I understand what they're trying to convey. But if you're not an investment professional, there's probably a few questions that immediately come to mind from that definition. And to be fair, Investopedia fleshes them out elsewhere to some degree. The first question is, why do I need to mix a wide variety? What constitutes a wide variety of assets? And when they say mixes, are any asset mixes acceptable? What does that all mean? And then I'd add on to that their statement on higher returns, lower risk. Do diversified portfolios actually bring higher returns? And do they lower the risk? No and yes, let's put it that way. And if we get into Investopedia on what they consider a wide variety, I think if you look on their website, they're probably talking 25 to 30 stocks would be sort of a typical wide variety from an equity side. Again, don't necessarily agree with what they're saying, but I do understand why they came up with that amount. And hopefully as we go through this, you'll sort of see there's a bit more nuance than the Investopedia statement. Asset correlations. That's what drives diversification. Your asset correlation is simply a statistical measure. It measures how one asset moves in relation to a second. And how assets move is usually a function of risk factors. We saw that when we looked at systematic and non-systematic risks. So systematic risk, which is wide-ranging, affects an entire market or market segment. That might be general economic conditions, like the prime interest rate. If the prime rises, that's going to affect all companies that have debt. It could also be something like a hurricane coming through the Caribbean and destroying every house on an island that it hits. You can't really escape the impacts of government economic positions or monetary strategies, fiscal strategies, the same as you can't avoid a natural disaster. From a non-systematic side, though, that's the credit rating that you have. So if prime suddenly goes from 3 to 5%, how you run your business, how your debt to equity ratios are, the quality of your assets, your past history of repaying debt, all those factor into your individual credit rating and put you on some kind of a curve, maybe very close to prime, maybe far away from prime. But how you run your business or your personal affairs may be completely different from the person next door to you. So that's why it's non-systematic. It's unique, specific to that individual, that company, that investment. So what we find here is that the closer in characteristics two assets are, the more they will be affected by the same risk factor. Conversely, the more divergent two assets, two companies, two individuals are, the less there will be affected by the same risk factor. And that kind of is the heart of asset correlation. It's a relative concept. You might have two assets that are 100% perfectly correlated. They're going to move pretty much in lockstep because they are so similar. You might find another two assets that have zero correlation. How one risk factor impacts one has no bearing on the other. Or you may find 100% negative correlation. So a risk factor on one will have the completely opposite impact on the other. And the way that it's set up, the 100% perfect and 100% negative, that creates an asset correlation value that will range from -1 all the way up to +1. And most assets or investments are not 100% perfect, and we'll see why later. So they'll sort of probably range from -0.4 to +0.8 or 0.9, in that range on both sides of zero. And the idea is when you diversify, the lower the correlation, the better the diversification, because risk factors will have different impacts on two different negatively correlated investments. So let's grab a cup of coffee and look at Starbucks, for example, just as a way to look at asset correlations from a common sense perspective. So I've got two Starbucks. I'm in Los Angeles, California. We are literally kitty corner in our Starbucks. And if you go to many cities, that's probably not far off. So I have two Starbucks. They're gonna be pretty much the same, right? I mean, it's the same Starbucks, same coffee. It's little differences, like we discussed with non-systematic risks. Management risk is big. Maybe one Starbucks has a better manager. Maybe he or she does a better job of selling product. The display cases are more appealing, so I sell more coffee mugs or I sell more coffee beans. Maybe one of the stores has better baristas, so that the queues move faster. And I can think of two Starbucks that I know personally that are within a block of each other, and one is habitually slow, the other is fast. So even if there are more people in the queue in the faster one, I know that I'm going to get in and out quicker. So that impacts my decision making. So that's two Starbucks in Los Angeles. They're going to be the same, but there'll be some slight differences. And because they're in Los Angeles, if there is an economic downturn in California or the city itself, that may have an impact on both stores equally. People are saying, oh, I can't afford overpriced coffee. I'll bring mine from home because I don't have that disposable income. Times are tight. That might be a little bit different than two Starbucks in Los Angeles versus a Starbucks in LA and a Starbucks in Zurich, Switzerland. Economic situation in California probably doesn't have a huge connection with the economic situation in Switzerland. There might be some generalities, but overall, how the economy in LA is different than the economy in Zurich. So you'd expect less correlation, less connection between those two Starbucks. You could also see a difference between a Starbucks in LA and a Italian espresso shop down the street. And maybe what happens is that Starbucks is being investigated for selling coffee laced with carcinogens. All the Starbucks will suffer, but the espresso shop, the independent one that's down the street, may actually prosper because of the lost business at the Starbucks stores. So maybe there's a slight negative correlation in some aspects there. So that's kind of the differences as well. If you get an earthquake in Los Angeles, that's not going to impact your Zurich shop. And if the Swiss economy suffers, or there's a fair number of Starbucks in Zurich, but the Swiss, they tend to prefer the classic Italian espresso shop where they get their shot of espresso in a nice cup. They have their biscotti, and that's a little bit more the Swiss way than having a espresso, for example, from a Starbucks. They do like the fancy drinks, though, at Starbucks. So you see, even with a Starbucks, yeah, they move together, but there's going to be some differences based on how they run their business, the operational risk, the management risk, those sort of non-systematic or specific risks. And again, from a latitude or geographic basis, big differences between a Starbucks in Sydney, Australia, Zurich, Switzerland, Los Angeles, California. Now, if we look at, let's say, a negative correlation. So times are good in LA. Everyone's out buying overpriced coffee, frappuccinos for all. Suddenly, recession, depression hit LA. People are making their coffee at home. It's tough times for the Starbucks. But maybe the pawn shop next door to the Starbucks in downtown LA is beginning to prosper. And that's probably quite factual, is that during tough economic times, things like pawn shops do quite well. And then when the economy picks up again, you're going to see less business at the pawn shop, and it's back to frappuccinos for everyone again at Starbucks. So there's an example of how you can have very similar businesses, but even they have some slight deviations in how risk factors impact them. and how the bigger the differences between a business, even the same type, two Starbucks in different cities, risk factors will impact those differently. And as you move farther and farther away from a Starbucks to a Italian espresso shop, to a pawn shop, or maybe to a watchmaker in Geneva, Switzerland, the impact of risk factors differs more and more. And that's how you create diversification, is you're looking for assets with different impacts from risk factors. And by building a portfolio up, you can reduce the overall risk. So that's sort of a Starbucks analogy. Next time we'll take a look from more of an investment perspective. We'll look at some actual investments like Exxon, Chevron, maybe a different mutual fund, and see how they work together in a portfolio to reduce the risk, and if they actually together provide a higher return. That'll be next time in part 2. Thank you for today, and have yourself a good one.